It seems to me that a lot of people today are saying, why don't we go back to normal, like the period from '09 to 19? And, one of my strongest beliefs is that that period was not a normal period. That was an unusual period in which the global financial crisis necessitated a high level of stimulus, and the low level of inflation permitted it. And so the Fed reduced the Fed funds rate to zero at the end of '08 to fight the global financial crisis and left it there for 7 years. And that really created a halcyon period in which we had the longest economic recovery in history, the longest bull market in history, a very, very low level of defaults and bankruptcies, a good period of corporate performance. It was easy and cheap for corporations to raise all the money they wanted. It was just an ideal period. And in short, I don't think that the period ahead is going to be such a period. Most people conclude there'll be a recession within the next year or two, and I find it easy to believe that because the record of producing soft landings where the Fed cools off in the economy and inflation by raising interest rates, but not so much that it produces a recession. The record is poor in that regard. So, less stimulative Fed, the probability of a recession, credit not so easily available, defaults and bankruptcies. I think it's a different period. In addition, I believe something that I think you believe, which is that the growth of the U.S., and maybe not just the U.S., is decelerating. Again, people say, well, why don't we just go back to normal like the second half of the 20th century? I think that was the greatest period in history. And there were a large number of reasons why economic growth was unusually good in that period, because those are reversed. And for other reasons, it's not going to be as strong in the period ahead. And by the way, this longest economic recovery in history, which we had in the last decade, was also the slowest. So that, I think, supports the argument that we have slow growth ahead and a less ideal environment for corporate managements and for asset ownership. What you learn in school is the way things are supposed to work, and most of economics is about the way things are supposed to work. But, Yogi Berra said that in theory, there's no difference between theory and practice, but in practice there is. And when you get out into the real world, you see that investors fluctuate. And for a long time, for example, they'll emphasize the positives, ignore the negatives, and if things are ambivalent, interpret them positively. Then all of a sudden, they'll flip and do the opposite. But for it to happen all of a sudden, there usually has to be a catalyst. And there hasn't been a catalyst. So I think that people are holding on to old positivity. And we know that if people hold a certain view, when new information that comes in that is in contrast with that view, the brain has mechanisms for ignoring it until it becomes so great that it can't be ignored. And that's when people flip. There's an old saying in the markets that things take longer to happen than you thought they would, but then they happen faster than you thought they could. I think that in the absence of a catalyst, and there hasn't been one, in the absence of that, people can still hold their views, which, as you say, might be more positive than they should be. And I think that for the people in the audience who are taking or have taken Econ 102, which is micro, it's a great illustration, because we always say that the solution for high prices is high prices. High prices encourage supply and discourage demand and result in lower prices. And I think this may be a great example of that. I guess there's a bias toward low rates because everybody likes them. The borrowers like them, the government likes them because it makes it cheaper to issue debt and so forth. And the markets push back on any attempt to raise rates, temper tantrums and so forth. So I just think that the rates were pushed down and kept down, unnatural rates. And I think we're going to go back to something more normal, whatever that means. And in this memo that's coming out, I'm very explicit that we don't bet on any forecasts, including mine. But I think that the Fed funds rate over the next X years, several years, I say, which I think of as 5, 6, 7 years, is going to average in the 2 to 4 range, not in the 0 to 2 range. When I say I'm not that interested in forecasts, basically what I'm talking about is macro forecasts, economies, currencies, commodities, interest rates, and markets. And anytime we buy something or unbuy it, we're making a judgment about the future, but we tend to do it on the basis of judgments about the micro, companies, industries, and securities. And we're usually pretty agnostic with regard to the macro. When we look at the future from the point of view of an investor, It's not a question of whether you can predict the future, but whether you can formulate a profitable prediction. If you predict something and everybody else predicts it and you're right, that prediction doesn't make you any money. And when I say we're agnostic with regard to forecasting, I haven't met many people in my 50 plus years in the business who could consistently produce profitable, which usually means non-consensus forecasts. With regard to the micro, I think we and others can get an edge by knowing more than others. With regard to the millions of factors that produce the macro, I don't think we can get an edge in knowing more and processing the information better. My last book was called Mastering the Market Cycle. And when I was working on that with my son, Andrew, who's a venture capitalist and my sounding board, I said, I think actually when I look at it, my macro calls about the market have been right. And he said to me, yeah, Dad, that's because you did it 5 times in 50 years. 5 times or 6 or 4 or 7 in my career, the market was so extreme, the logic was compelling, and the probability of success was high. But if I had tried to do it 50 times or 500 times or 5,000 times, I would not have a batting average above 50%. So, yeah, it's exception that proves the rule. It's possible at the extremes to make a profitable macro call. And if you're right about the fact my macro calls are usually predicated on an observation that the market is too optimistic or too pessimistic. And if you observe that the market is too optimistic, which usually means that people are lending money based on poor credit decisions, then I think you can predict that bankruptcies will rise.